It starts with a whisper and becomes a stampede. A forgotten stock explodes, a crowd forms, and the market bends under the weight of pure momentum. In this video, I'll show you the hidden force behind today's fastest financial shocks and why no one sees the reversal coming until it's too late. If you think you're immune to social media, stay with me. This might change the way you see social media, people, and yourself. A market roiled by the crowd. It didn't begin with a warning, it began with a post, a screenshot, a joke, a few lines of text shared at the right moment or in the right place. Within days, a forgotten stock was no longer forgotten. Its price was rising not because of profits or products or growth, but because millions of people were watching the same screen at the same time. Markets started moving faster than explanations. Traders woke up rich, others went to sleep confident and woke up ruined. Institutions that had dominated markets for decades suddenly looked confused. Risk models failed. Trading was halted. News anchors struggled to explain why prices no longer made sense, and underneath it all was something older than finance itself. A crowd moving together, driven by belief, momentum, and the fear of being left behind. This wasn't an accident. It was a pattern revealing itself in a new form. If you want to understand the story behind the chaos, the signals before the stampede, and the psychology driving the crowd, subscribe now. This channel is where the noise becomes clarity, the rise of new market voices. Not long ago, markets had gatekeepers. Information arrived slowly, earnings were read in the morning paper, and analysis came from a small circle of professionals. By the time most people heard the news, the biggest decisions had already been made. Then the screens got smaller and the crowd got closer. At first, it felt harmless, investors sharing idea and traders comparing notes. A new generation learning the language of markets together, but something subtle was changing beneath the surface. Conversation turned into coordination. A rumor no longer faded by nightfall. It was reposted and amplified, repeated until it felt solid. Confidence spread faster than doubt and charts were simplified. Risk was joked away and each new voice made the signal louder. Trading stopped being an event. It became a reflex, a notification buzzed and a trend appeared. Thousands acted at once, not after careful thought, but out of rhythm with the group. This wasn't just more participation, it was synchronization. For the first time, markets weren't just reacting to information, they were reacting to each other in real time, at massive scale. And once that started, there was no going back. Hidden weaknesses in the system. From the outside, the system looked stronger than ever. Markets were liquid, trading was fast and participation was high. Prices updated, every second giving the illusion of constant stability. But speed can hide fragility. Beneath the surface, the structure was thinning. Risk models were built for institutions, not crowds that moved together. Liquidity assumed disagreement, buyers and sellers with different views and acting at different times. But social media erased those differences. It taught millions of people to see the same opportunity at the same moment. When everyone rushes in together, depth disappears. Leverage made it worse with easy options, margin with a tap, and small moves suddenly mattered. A rumor could force buying and buying could force more buying, and no one felt responsible because no one felt alone. The system relied on hesitation, doubt, and delay. Social media removed all three. Platforms didn't slow this down, instead they accelerated it. Volatility meant engagement, and engagement meant growth, and growth meant ignoring how quickly confidence could turn into panic. Nothing was broken yet, but everything was stretched, and stretched systems don't fail gradually. They hold, they reassure, and then, without warning, they snap. Herding, fear of missing out, and viral sentiment. It usually starts quietly. Someone posts a chart and another adds a comment. A third says they're already in. At first, it feels like conversation and people thinking out loud. Then the tone shifts, the story becomes simpler. The outcome sounds certain and doubt starts to feel like weakness. No one wants to be the only one standing still while everyone else is moving. Screens fill with gains. Success is shared instantly. Losses disappear into silence. And the longer the move continues, the harder it becomes to question it. And this is how herds form. Not through orders, but through reassurance. Every post confirms the last one, and every new buyer becomes proof. Caution looks outdated and patience feels expensive. The fear is no longer losing money, it's missing the moment entirely. FOMO isn't panic, it's anticipation under pressure. People don't rush because they're scared of collapse. They rush because they're afraid the door will close before they arrive. And social media shows them, minute by minute, exactly who already made it through. At that point, the crowd no longer needs facts, but it has momentum. Prices rise because people believe they will, and belief spreads because prices are rising. Once belief becomes the fuel, reality struggles to catch up until it does, all at once, denial and overreach. By the time doubt appears, it's already unwelcome. The story has gone too far to stop. Too many people are committed. Too many screenshots have been shared. Pulling back now wouldn't just cost money, it would cost identity. So the explanations change, volatility becomes healthy, and warnings become fear tactics. Anyone questioning the move is labelled out of touch, or worse, part of the opposition. Platforms benefit from this stage. Activity spikes and engagement explodes. The more extreme the claims, the more attention they draw. Influencers feel pressure to stay confident. Admitting uncertainty means losing the crowd. Institutions aren't immune either. Some dismiss the move entirely. Others chase it late, convinced they can still control the outcome. Risk limits stretch and assumptions bend. Everyone believes they'll be smart enough to exit in time, but exits don't work that way. Overreach isn't reckless at first, it's gradual, comfortable, and justified. Positions get bigger, time horizons get shorter. The original reason for the trade fades, replaced by one simple rule: stay in while it's working. This is the most dangerous moment, not when fear dominates, but when confidence becomes untouchable and denial doesn't stop a collapse, it invites it. When the stampede hits, the shift is almost imperceptible at first, a pause where there used to be momentum, a dip that doesn't bounce immediately, and a silence where reassurance once flooded in. Then selling begins, not out of fear, but out of instinct. Someone tries to lock in gains, another notices the volume changing, and a third realizes the crowd is hesitating. And hesitation in a synchronized market is enough, and liquidity evaporates. Buy orders thin out. Prices start falling faster than they rose. The same speed that carried the stampede forward now works in reverse. Posts turn urgent, confidence fractures, and everyone searches for the exit at the same time. But exits were never built for crowds. Trading halts, apps freeze, quotes lag reality, and people refresh their screens, watching profits disappear in seconds, then minutes, then entirely. This is when the realization hits. The crowd that pushed prices up cannot pull them back down gently. There is no orderly retreat, only gaps and drops. The sound of momentum is breaking apart. Latecomers are trapped, and early winners hesitate too long. Explanations no longer matter, and fundamentals reassert themselves without warning. The stampede doesn't end with a crash, it ends with disbelief. Screens go quiet, threads disappear, and people are left staring at numbers that no longer feel real. This is how it always breaks. Slow confidence and sudden collapse. Echoes through history. None of this is new. Long before screens and servers, crowds moved markets the same way. They gathered in streets, coffee houses and trading pits. News travelled mouth to mouth, and confidence spread hand to hand. The technology was slower, but the psychology was identical. In every great mania, people believed they had discovered a shortcut, a way around risk, and a reason why old rules no longer applied. Prices rose, not because value changed, but because participation did. Tulips, railroads, dot-com stocks, different centuries, but same rhythm. Early believers were rewarded and skeptics were mocked. Late arrivals were reassured there was still time, and when reality finally intervened, it did so without compromise. History shows this clearly. Crowds don't need bad intentions to cause damage. They only need alignment. What social media changed wasn't human behavior. It removed distance. What once took years now takes weeks. What took weeks now takes days, and sometimes hours. The pattern survived every new invention, and each time, people insisted this version was different. It never was. Why this matters today? What makes this moment different isn't the crowd, it's the scale. Never before have so many people been connected, synchronized, and financially exposed at the same time. Markets now react not just to earnings or policy, but to narratives and stories that spread faster than corrections ever could. This doesn't stay contained inside trading apps. When stampedes reverse, losses don't vanish into charts. They hit savings, retirement plans, and confidence itself. Trust in markets erodes quietly, then all at once, and the system learns the wrong lesson. More speed, more access, and more leverage. Each cycle trains the next one to move faster and with less patience. The pauses get shorter, and the reversals get sharper. This matters because patterns don't need villains to repeat. They only need conditions, and those conditions are now permanent. How social media creates financial stampedes. It always feels sudden in the end. One day, the crowd feels unstoppable. The next, it's gone. Looking back, the signs are obvious. The certainty, the speed, and the way doubt was drowned out by momentum. But in the moment, none of it felt dangerous. It felt collective, reassuring, and powerful. That's the illusion. Social media didn't invent greed or fear. It didn't create speculation or risk. It simply removed friction. The pauses that once gave people time to think alone instead of move together. When thinking becomes collective, markets stop behaving like systems. They start behaving like crowds. Financial stampedes don't require lies, manipulation, and they don't even require bad intentions, but they require alignment. Millions of people seeing the same signal, hearing the same confidence, acting at the same moment, and believing just briefly that they'll recognize the exit before everyone else does. History shows what happens next. Prices disconnect, reality returns, and the crowd learns again that speed cuts both ways. The pattern isn't hidden anymore. It's playing out in public in real time and on our screens. The only question left isn't whether it can happen again. It's how fast. If you want to understand the story behind the chaos of behavioral finance and panic psychology, subscribe now for more upcoming videos. This channel is where the noise becomes clarity.